Okay, in this video, I'm going to talk about the Chapter 6 homework, kind of some of the things to think about as you're answering those questions and kind of where to go with them. Okay, I'll look at it this way. Now, keep in mind, your questions may not be in the same order. I think the system really tries to make our life difficult by scrambling the order. And I wish I could figure out how to turn it off, but I do not know. So I printed things out. So you're going to hear me page rustling here because I basically did the homework assignment on paper so that I could then talk about it in this video. Okay, so here's my first one, at least in this view that I'm looking at it. What does time series analysis help us do when we're trying to identify financial trends? So keep in mind here that this is a definitional question where really what we're doing here is we're trying to, with a time series analysis, analyze the sequence of data over time. Well, I kind of gave away the answer here because what that means then is that we're not looking at things at a single point in time. So you kind of cross out both of these. And so our definition of time series analysis is time based, but it's over time for a single company. So that is the correct answer. I don't know. Let me. This is the last time you can check your work. Sure. Hey, thank God. Okay. I'm not going to do this for each one. I was just kind of curious here. Turn to question. Kind of how do I get to the next question? Here we go. Okay. Monero Company. And okay, so let me find that one. Sorry. You would think there's an easier way to do this to talk about it, but I haven't figured that out yet. Sorry, you're going to hear again rustling pages as I try to find the page here. Okay, I found this one. Okay. So this one, we're looking sorry, I don't have the right page here. Here we go. Okay. So we can see here that the increase in operating income is that it went from 10,000 to 13,400. So we want to understand that $3,400 increase. So that's what we're trying to understand. Why is that going up? And more specifically, how much of that $3,400 increase was caused by the fact that the operating margin was increasing. So we need to find the operating margin for each year. So that's kind of the key to this question. So in 2012, that operating margin would be the $10,000 in operating income divided by the sales of 162,500, which, if my math was correct, was 0.061538. And then in 2013, that would be 13,400 divided by 178,400 for 0.075112. So now the difference between those is 0.013574. I did the 0.075 minus the 0.061. et cetera, et cetera. So you have to do 2013 minus 2012 to get the 0.013574. Now what I need to do is I need to create an equation here where I start with the operating income in 20x2, 10,000. And I need to take into account two effects. So there's two things that are affecting the increase in the operating income. One being the fact that I'm selling more, so I've got sales growth, but also the fact that my operating margin is increasing. So how much is it increasing by? That would be the 178,400 minus the 162,500 times 0.061538. So that's going to be the effect of my sales growth. So what I'm trying to get to here is 13,400. So 10,000 plus the effect of the sales growth increase. This is equal to 978. And then I need to get my margin increase. That would be my 2013 sales. That would be the 178,400 times the increase in the operating margin. That's that answer I found right here, times the 0.013574. That's 2422. And I better hope to dear God that 2422 plus 978 is going to be 3,400. Thank fucking God. Okay, so 10,000 plus 978, which is again the effect of the sales growth, plus the 2422, which is how much my margin is increasing by, gives me my 13,400. So what's the effect of the margin increase? That's going to be this answer here. Hopefully. Let's hope this is a choice. Yeah, so you should be right there. Well, why not? Yep. Okay, good. Okay. Okay, let's look at number 3. Again, I may not do this for every question here, this kind of detail, but I'm going to start off that way at least. Days receivable. Okay. So now we've got to find the days receivable. So for this, we need the general equation that's found in the book of the 365 days that are in the year divided by the accounts receivable turnover, which is what we're going to need to solve for. So we need to find that. How do we solve for this? Well, that is equal to our net credit sales divided by our average accounts receivable, which in this case is going to be the net credit sales. Our sales are right here, 1640000. And we're going to divide that by the average accounts receivable. So we're going to take the average of these two numbers here. So you could add 267,500 plus 230 divide by 2. And I got 248,750. So I'm just averaging these two numbers. If I divide these out, I got 6.6. So that would mean then that 365 divided by 6.6 is equal to 55, and that would be days. I'm going to hope here it's an option. Looks like it is. Let's check our work. Okay, there we go. Okay, let's clear this up here. Which of the following is not an action? So for these, I'm not going to... I'll let you kind of look up things in the book. Let me just talk about it briefly. Let me just find my notes that I made for this question. If I wrote any. Okay. Yeah. So, again, this is a definitional question. I'm not sure what more I can add to it except the fact that um, if you look in the book, you'll see which of these options is correct. I'm sorry to be so cagey about it, but this one, in this case, you can kind of look it up and see. Think about, though, when you're in default, even what a business would be able to do against you. Um, Generally speaking, can they file a court case? Yes. Um, can they allow you to adjust your payment schedule, right, so that you can pay things on time? Yeah. Will they modify the payment schedule and in exchange they'll increase the interest rate? Yeah. Can they contact your customers and collect the receivables themselves? I haven't heard of any cases like that. That would be highly unusual. So the correct answer should be this. But again, just think of if you have any experience with how bankruptcy works for firms. Generally speaking, if you're having problems paying back your bills in your business, these are the options. Um, your creditors are not going to get involved with finding out who your customers are and directly collecting things. Debt financing. Okay. Sorry, I gotta find my question notes here. Sorry. I'm looking on my. Oh, here it is. Okay, so this is also kind of a definitional question. Basically, what we're looking at here is what is debt financing essentially? Is it the only option or is it one of multiple options? Um, is it always the case that it's better than equity financing? That is not the case. So it's not always the best case. It really is an art form to determining what is best, debt or equity, and it's based on you and your analysts, you as the business owner and your analyst's assessment of um, what the growth prospects are for the company. So it's not just tax deductibility of interest expenses. That's not the only reason why debt financing would be better. Although the interest is tax deductible, it isn't always the best choice. Um, so then the other options then would be: is it only used by emerging growth companies? Is it an option that both established and emerging companies can use, or is it only used by established growth companies? Well, option B and D make it pretty limiting. Debt financing is done by both growth companies and established growth companies. There's no rhyme or reason. You see the large cap companies like a Procter and Gamble using debt financing. But you may also see a small company doing it because they don't want to give up equity ownership in the company. Yeah, so the answer is C. I don't know. I kind of find this helpful talking about it. I'm just worried about how long this video is going to become if I keep doing this. But I guess it's kind of helpful to talk about it. Although some of you are probably in the background saying, damn it, Shiting, shut up. Trend statements. This is trend statements. There we go. So, what do trend statements do first? Well, they identify kind of the changes over time. Trend statements, by their very definition, if they're identifying changes over time, it's not going to identify the variations between companies. It's not a cross company comparison. Is it going to spot relationships among financial statement items? No, that's just definitional to how accountants and analysts do their job. So the relationships between line items, that's just by the science of the discipline. Does it determine the reason for changes? No, that would be kind of a description of things going on over time. And then finally, does it help you spot changes over time? Well, that is the definition of what a trend statement does, is it allows us to kind of focus our attention on those things that are identifying, that are changing over time. But it doesn't say anything about how those changes are occurring at different companies. It doesn't say anything about why they are changing. It just tells us that they are changing. Okay. I don't know why. I mean, I do need to check my work because I did just do it myself here. Okay. Number 7. All the following are used for financial analysis tools except. Okay, here we go. So what is used in a financial analysis? So 3 of these are going to be present. One of them is not used. Financial analysis, dude, it's numbers. Common size statements, trend statements, financial ratios. That's what an analyst deals with. I don't care what a manager thinks if I'm an analyst. I mean, I care, but I don't, because they're always going to say things are great. It's the numbers that don't lie. So, dude, you better be answering that. Okay. Trend statements are better than common size statements. Yeah, this one is just definitional. Why is it that trend statements are better than common size statements? What would it be best at indicating? Well, it's not going to say very much about stability. It's not going to say much about stability because in a we would need to know something about how things are. Um, let's just remember what a trend statement does. is it's telling us, a percentage of the base year item. So it's not going to tell us very much about stability, because both the numerator could be changing as well as the denominator, or both. So we're not going to get very much out of stability. I don't even know what monetary changes means. Um, I didn't make this assignment, but that doesn't even make any sense. Profitability. There's a lot of things that go into profitability. The trend statement isn't going to tell us much about that as opposed to the common size statement, because profitability is contributed to by how good are you at reducing your tax liability, how good are you at managing your debt financing, how good are you at your sales, how good are you at your cost of sales. That all feeds into profitability, and a trend statement doesn't tell us much about that. What the trend statement does tell us is how things are growing or shrinking over time, and that would be where we that. And this is in some sense definitional. Okay. Now we've got something to solve here. Intangible assets for Phoenix Corporation. Okay, so we need to calculate the long-term debt. Ratio to tangible assets. So our long-term debt here is 77,500, and we're going to divide that by the ratio of our. We need to find the tangible assets. So tangible assets would be determined by taking our total assets and subtracting out our intangible assets, right? Because then the remainder would be tangible assets. So that would be 77,500 divided by 825 minus 50. And the answer there is 10%. Hopefully that is an option. It is. I can see it right here. It is. When I answer these, I'm not trying to be like, I should say this too. I'm not trying to be like cocky and be like, oh, yes, I'm just zipping through this. I mean, I did write out notes to solve this on the paper, so that when I made this video, it was a little bit more refined. And I'm not just like seeing it for the very first time. So, I mean, I don't want you to think like it's just like second nature that I'm doing this. I mean, obviously, I was able to do it without looking up stuff, but at the same time, um, this isn't an impossible problem set, and it does help you prepare for the exam. So it is worth your time, both watching this video as well as kind of struggling through it yourself. Solvency. Okay. What is solvency? Well, this is definitional. And all this is, how am I able to pay back things that I need to over the long run? So it's my long-term ability. It's not my short-term ability, so it can't be this. And there has to be a time frame here, so it's not this. It is my long-term ability. Is it just to generate cash for my plant capacity needs and fuel growth? Or is it plant capacity needs, fuel growth, and repay the debt? It's all three of these. And this is just definitional of what solvency is. Okay, trend balance sheet. This is definitional. I did just talk about it a few questions ago, but this is in a trend balance sheet. You're taking each balance sheet item as a percent of whatever that base year is. And that's just definitional. There's nothing I can really add to that. Besides, look it up. Okay, we need to find the current ratio for the Phoenix Corporation. Okay. Well, this is just our assets divided by our liabilities. So in this case, it's going to be for 20x2, our assets here are 670. It's our assets divided by our liabilities. So that's going to be our 670 divided by our liabilities, which is the 252,500. Which is 2.7 to 1. And hopefully we have an option that's like that. We do. Let's make sure. It is. Okay, let's look at the next one. Monero Corporation. We need to find the effect of sales growth for Monero Corporation. Sorry, I just really have to find this. Yeah, here we go. Okay. So this one's a little bit tougher to solve for. So we need to find the effect of sales growth. The first thing we need to do is we need to calculate the operating margin. So that operating margin is going to be my 10,500, my operating income, and I'm going to divide that by my sales, my 155,500. So first thing I'm doing here is I'm solving for my operating margin. So I'm taking 10,500 divided by 155,500. So that's going to get me an operating margin of 0.067524. That's my operating margin. Now what I need to do is, this is just like that other question where we did this. I now need to find out what the effect of the sales growth is on the operating income change. So the operating income, we can see the effect of the sales growth. So we changed from 162,500 from 155,500. So I need to take 162,500, which is what my sales are in 20x2, and subtract what they were in the previous year. Okay, so that difference there is 7,000. And I need to then multiply that by my operating margin, 0.067524. Okay. I got 472.668. So basically 472 and 67 cents. Or rounding it, I'm going to hope that the answer is 473. Yep. Okay. Clear this. Which of the following is not correct with respect to calculating RCOE? Okay, so in terms of our returns on the capital employed, this is just definitional, and this involves us. There's not much really I can say without saying what the answer is. Um, so when we're looking at RCOE, basically what we have to do is we have to look at the net income and we need to subtract out the dividends that we paid to the shareholders, um, so that we can get the rest of the income that would be available. So the common and preferred stocks dividends need to be subtracted out. And then what's left is the return on capital employed because you've paid those dividends out. So unfortunately, I have to give away the answer to um, talk about it. Okay. Long-term debt to asset ratio. I know this is like a rip more in time, huh? Long-term debt to assets. So here we need to take the long-term debt and just divide it by the total assets. So the long-term debt for 20x2 would be 77,500. And we're going to divide that by the total assets, which would be the 825. And I got 9.4%. So here we go. We got an option that's like that. There we go. So that's just our definition of that. Which of the following helps an analyst remove the effects of information filler? So this is definitional. There's really not much I can say beyond this, so you just need to look up the information filter um, and what could help us remove the effects of that. So remember, what the information filter does for us is it's the fact that the filtering of the information is done by the manager. So what would help us remove the fact that a manager might not include things, right? So there's an art form to a financial statement. Even the SEC 10K doesn't tell us everything we need to know, because only certain things need to be, standards need to be met in terms of the numbers. Um, it's really the notes, as I said in the lectures, where the exciting stuff happens and is disclosed, where you get to know as much as the managers do, depending on how closely you look at that. And if you don't learn very much from this course, I would hope that you would learn that in reading a financial statement that the notes do matter. They're not to be ignored. So this one I did remove. This was one of the longer questions with a balance sheet. Since we didn't talk about it in class, I did remove it. Companies that consistently earn rates of return above. Yep, so this one is definitional. How would I be able to consistently earn something above the competitive floor, Well, I must have then some advantage. What would that advantage be? Well, if it's a competitive floor, it's a competitive advantage. It wouldn't be monopolistic because I don't have competitors if I'm monopolistic. Niche market, that's not even a um, technical term really for an economist or for an analyst. And then dominant market share, that's important, but um, it's not what gives someone a competitive advantage necessarily. The most general thing to say here would be that I have a competitive advantage. Okay. Now we need to look at the long-term liabilities for Hansel Corporation. Okay, so our long-term liabilities in 20x3 is 395,000. And I'm going to divide that by, because this is a trend balance, as a fraction of what's going on in 20x1 is 375. And what I got was 105.3. You would have to multiply this by 100 to work as a percentage. So 105.3. And there we go, right there. So again, trend balance sheet, we're just looking at how these statements are changing over time. Okay. Now we're looking for the quick ratio for Phoenix Corporation. Here we go. So we need to basically divide our assets by our liabilities. So in this case here, our assets for 20x2 is 670. And we're going to divide that by our oh, sorry. No, sorry. I want a quick ratio. Sorry. So for this, I need to take my total assets and I need to get rid of my inventory. Sorry. So I need to get um, my quick assets. I need to take my total assets of 670 and get rid of my inventory of 312,500. And that's going to get me 357,500. And then I need to divide this by my current liabilities of 252,500. And there's my quick asset, my quick ratio. And so my quick ratio here would be 1.4 to 1. So hopefully I've got an option that looks like that. And I do. Oh, shit. Sorry for erasing that. You need to. And I'm right. Okay, rewind it. Sorry if you missed the numbers there. Asset utilization. So this one is definitional again. And really, it just, there's not much I can say beyond what the book says, to be honest. So, for instance, things, and so we're looking for the thing that is not correct. Um, so asset turnover is one part of the return on assets calculation. Yeah, that is true. That's not the answer. How efficient is the company in utilizing property, plant, and equipment is reflected in its long-term asset turnover ratio. Yeah, that's actually what the long-term asset turnover ratio does. And efficiency gains arise from improvements in managing accounts receivable. Yeah, if I get paid back by my customers faster, and I manage it better with less, with things being paid back quicker, that would be an efficiency gain. So our correct answer here, or the incorrect statement, which is the correct answer, would be inventory obsolescence. There's nothing in terms of asset utilization where you would see inventory obsolescence in the asset turnover ratio. Okay. Monero Corporation and the trend statement. There you go. So, what would our sales be expressed as? So, for this trend income statement, then what I need to do is take the 20x3 amount, which is the 178,400, my sales for 20x3, and I need to divide that by the 20x1 sales of the 155,500, and that ratio would be 114.7 percent. So that's again just how we do a trend statement. Yeah. Okay. Accounts receivable turnover ratio. This is definitional. I'm not sure what I can really add to it beyond what the book has here, but it is the information that we need. There is our net credit sales, so we can already cross out the first two because we do need net credit sales, and we are looking at the average accounts receivable as we had calculated it before in the previous question. So this is just kind of a definition of the work that we had done already mathematically. Okay, common size statement for Monero Corporation. Okay, so now I need to do the cost of goods sold in 20x3, which would be 115,000. So cost of goods sold in 20x3. And I'm going to divide that by the sales, the 178,400 times 100, just to calculate as a percent. And that's going to be 64.5%. So as you can see here, a lot of this is just applying the equation here. And that is what you'll see on the exam. Financial ratios. This is definitional. Why do we, if we're trying to assess credit risk, determine credit risk, why are we using financial ratios? Dude, I want to get paid back, right? I want to know how solvent the company is and how they're going to be able to have cash that exists. I don't care what their profitability is. I care if they're going to remain a going concern. and I care that the money that they're bringing in is cash that they can use to pay back their loan. So it's solvency and liquidity. It's definitional. If I want to get paid back and I'm trying to determine someone's credit risk, I want to know, is this business going to continue on and are they generating enough cash? And then these two are removed. Okay. I know I actually gave out answers. I wasn't actually intending to do that as I started to go over these, but my hope would be is that if you've watched this whole video, um, things are going to be a little bit clearer about why the answers are what they are. I would still encourage you, if you haven't done these questions, I would still encourage you to work through things yourself and not just watch the video to get the answer, because when it comes to the exam, you're going to encounter many of these same issues.